Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kostrup Larsen.
You're listening to Top Traders Unplugged, where I continue my conversation with Peter Kambolin, co-founder and CEO of Systematic Alpha Management. Tell me, Peter, how many markets do you trade altogether, and how many combinations of spreads do you have in your portfolio?
Yes, well, we trade approximately 20 to 25 different markets that include major global equity indices, major currencies, and we just use 3 commodities for hedging. We trade about 20 to 30 different spread combinations, but each spread we trade in a variety of different sub-markets, up to maybe 20 actually. What that means is that, let's say you have a spread that fluctuates, right? Goes up and down, etc. We apply different logic, different rules when we place trades, because we don't know the sine wave that a spread could experience, moving up and down, is not always the same. The amplitude of the move could be different, the time it takes could be different, etc. So we have models that on average would hold positions, let's say 3 hours. Some other models will have holding times of, let's say 10 hours, and others will hold somewhat longer. So we try to exploit short-term mean reverting moves in the spreads and longer-term mean reverting moves in the spreads, all within, let's say, day and a half, 2 days. And what's interesting is that by diversifying our holding time, the returns that are generated, they are often uncorrelated to one another. So let's say we could be trading S&P FTSE British Pound spread that holds for 3 hours, and it will have almost 0% correlation to the same spread that fluctuates the same, but which we would trade using a different holding time model. So this is one way to diversify. We have other ways to diversify our trading. For example, this is getting more technical, but we look at so-called intraday seasonality of the volatility of the spread.
Okay.
What that means is that there are 3 points within a day when volatility is elevated. At the early morning hours in Europe, vol is high in the spread because S&P could be mispriced. Mm-hmm. Late trading hours in US, vol is high because European markets could be mispriced because it's for them after hours. And around 9:30, 10 a.m. New York time, vol is high because that's when most price action is taking place. News come out, and that's when volatility is typically elevated during the day. So we have models that are taking into account these intraday seasonalities of the volatility. Again, for a long-term CTA, these intraday moves are totally irrelevant because they hold positions for months, for weeks, etc. If we hold positions for hours, it's extremely important to take into account intraday seasonality.
Sure.
So this is another way how we have different signals, different models, that we trade.
Sure.
And we have a number of others. So my point is that to answer your question, we trade anywhere from 20 to 30 different individual spreads, but each one is traded in up to 20 different ideas or submodels. So the total number of signals, individual signals that we monitor and trade is about 200.
Excellent. Now, from what you've explained, it appears to me at least that part of the way you're getting out of a trade is based on your target being reached or the spread coming back to the expected level. But you also talk about average holding periods of 3 hours or 6 hours or so on and so forth. Right. What triggers the exit if you haven't reached your profit level and you haven't been stopped out? Is it a time? Is there a time exit?
We don't have a time stop, but imagine a moving average or mean of the spread.
Mm-hmm.
And you can, if your look back window for the moving average is long, that moving average will be changing very slowly, every minute going. But if your look back window is very short, let's say it's 1 hour or 3 hours, it will be moving with the spread very rapidly. So if the spread goes up, the moving average will go up as well. So our so-called fast model, that the ones that hold only 3 hours on average, they have very short look back window for estimating the mean or moving average of the spread.
Right, okay.
Which means that if the spread goes up and then there's a small reversal, it will touch the trigger point.
Sure.
That's how it's done. So we don't have a particular time stop. We tested that idea. It doesn't work as well as trying to come up with different, moving average, look back window to estimate your fair value of the spread itself.
Sure. Now, staying just again a little bit with the trade and the model and so on and so forth, I wanted to ask you about how do you size your position? How do you work out, how much to put on in terms of these signals?
Well, the way it works is from the top to bottom. We know our overall assets under management figure. We also know what is the maximum exposure we would like to have if, let's say, all the models hit the trade in the same direction. This is our some target that we have that we will not reach.
Sure.
That defines how much risk we would like to trade overall. Then we look at 3 geographical regions. I mentioned before we trade Asian spreads, Asia against US, Europe against US, and US against US, or Canada is part of the North America. So we would break our risk among the 3 geographical regions, and that is done based on historical returns, our expectation of returns, quality of the returns, and for historical reasons, I would say 55 to 70% has been allocated to the European spreads. Anywhere from 0 to 10% to Asia, and the balance is North America. Once we determine that, and that review is done roughly every 3 months, we assign individual risk level to each country that we trade within a particular zone. Let's say in Europe, we currently trade UK, Switzerland, France, Germany, and Euro Stoxx 50, so 5 markets.
Mm-hmm.
So risk is assigned to each one, maximum risk again, depending on our historical P&L, our backtests, and various other tools that we use. And then within each country, we have a number of different signal spreads, as I described before.
Mm-hmm.
It could be up to 20 to 30 for each country. And then risk amongst these individual signals is allocated using an optimizer that we use that looks at 1 minute real return of these spreads over the last 4 or 5 years, and it tries to assign more risk towards those models that not only produce best returns, but also that are uncorrelated to the other models in the same set of portfolio.
Mm-hmm.
So we do not have even risk allocation to answer your question,
Sure.
have certain preferences in terms of the, geographical zones, in terms of the particular countries. For historical, again, reasons, we like US, UK spreads the most because they are most stable and most highly correlated.
Yeah.
And then within each country, we allocate risk based on our optimizer that we have, built proprietary.
And how many trades do you end up doing in a day on average with all these?
So out of
models?
roughly 200 signals, maybe, depending on the volatility, on average we would have maybe 20 trades a day.
Okay.
Most of the models actually stay in cache. So what that means is that if, let's say, S&P and FTSE are fairly priced in relation to one another, they're moving exactly or more or less the same up and down, there's no opportunity for us to trade at all. We'll
That's right.
Stay out. We will not have any positions at all, while we could be detecting a lot of positions or trades in, let's say, a Swiss SMI, Swiss franc, S&P trade. So if you look at our portfolio, day after day, it's not stable. It's changing all the time. We are not invested in all these markets all the time. We are arbitrageurs. So if we detect a mispricing, we will come in and provide liquidity.
Sure. And you gave a good example before where you had, say, the FTSE, the S&P, and then you had the currency side to things, which
Yes.
you mentioned was kind of I think you mentioned the word hedge component. Is there always this hedge component in the models? And if so, when you look at the P&L overall, how much of the P&L of return stream actually comes from the hedge component of the spread, if I can put it that way?
When we look at the P&L, we look at the P&L for the full spread. We do not try to understand, or we don't care if the P&L came from the equity market or the currency market.
Okay.
For example, we could be losing on the currency leg, but that currency leg will generate extra return via the index leg. So we don't dissect the returns coming from all three legs of the spread. We look at the spread itself.
Okay. And in terms of risk, open risk, I mean, I don't know whether it's possible to give an indication, but if you operate stops on all your positions, which is my understanding, can you say something to the point about what is kind of the daily open risk budget, meaning if everything, I mean, because you might use value at risk, I don't know, as kind of a something you look at, but my experience is that value at risk works great until the point when it doesn't work, and it usually is when the markets get very volatile and there's a crisis. So can you talk about how much open risk, meaning if everything got stopped out in a day, what kind of risk budget do you run?
Well, let me talk about the average risk that we're running and the
Sure.
worst outcome that we've had over the last 14 years.
Sure.
So the average exposure in our single leverage share class of the fund, we have single and double leverage. So in the single leverage share class, which has a 7% roughly annualized standard deviation,
Okay.
we are on average 60% in notional exposure long, 60 short. So let's say on a $10 million account, we would have positions notional exposure of 6 million long, 6 million short.
Sure.
That's on average.
Yeah.
That translates into a margin to equity ratio of about 12%.
Sure.
Why so high? Because we have to pay full margin for the long side. We spend about 5% on the long side, 5%, let's say, for the short side, and about 1-2% for the currency or commodity hedge on top.
Sure.
That's how we arrive to a 12% average margin to equity. And this margin to equity cannot be compared to a long-term directional, let's say, trader.
Of course.
They pay, one margin for one position, and it's in a directional position.
Sure.
So our stop loss levels are set around roughly 2% from the entry price. So let's say we put on a spread position, we can potentially lose 2% of the risk given to that spread, not on the portfolio, but to that particular spread. In terms of the worst day that we've had, and I think it happened in 2008, when I remember S&P was moving by 40 points in maybe 1 minute.
Wow.
Yeah, there were days like this. So the worst daily P&L was minus 2.2% realized. But on average, our daily returns are 0.2, 0.3, 0.4% up, down days.
Sure. Now, I wanted to shift gear a little bit, but staying on the point about sort of risk, I want to touch upon drawdowns because, perhaps a lot of people are not aware of it, but, CTAs in particular spend most of their time in some kind of a drawdown, and probably only about 20% of the time at, reaching new equity highs. So I wanted to understand a little bit about the drawdowns you've experienced, whether, what you've learned from them. I know you mentioned earlier you made some changes after one of the drawdowns and what you've learned from them. And also whether you think the drawdown profile of the program has changed with the changing of the environment that we've seen in the last few years.
Yes, one of the important modifications that we introduced in 2011 was a deleveraging mechanism, where if we reach a 5% drawdown, peak to trough, intra-month, not necessarily at the end of the month,
sure,
we will start reducing risk. Initial deleveraging is done by 25%, and it is done in those markets or spreads that are causing the drawdown.
Okay.
If we are reaching a 7.5% drawdown on the portfolio level, we will increase the deleveraging to 50%, and then the deleveraging is done across all the spreads, not necessarily only the ones that are losing money.
Okay.
And by doing that, we are basically trying to control the depth of the drawdown, because if you're trading less risk, it's harder to lose more and more money. Of course, on the other hand, it's harder to recover the losses, and our policy is that we will not wait for months until we reestablish the risk back. If we're seeing a recovery, if we're seeing some positive statistics, we will slowly put the risk back on, with the expectation that the recovery will be in full force, and we will quickly recover from a drawdown. So we believe that such deleveraging approach is helpful, especially during crisis times, because sometimes there will be these so-called black swan events, like for us in 2011, which were never part of the history, and estimating them or predicting them is sometimes next to impossible. So if you don't have these deleveraging mechanisms, you could be having major problems, in your drawdown.
Sure.
So this is what we're doing following 2011 experience that we had. And in 2011, our drawdown reached 19% at the worst point, although we ended the year minus 11%, because we had a strong recovery in the fourth quarter of 2011. By the way, that was the time when most other CTAs were entering the drawdown. We were already recovering from ours.
Yeah, no, absolutely. And the re-leveraging, going back to normal leverage, is that also a fully automated process, or do you have to have a little bit of a a role in setting the leverage, because you said you were looking for some improvements?
I would say it's more art than science. We would look at which countries, which spreads are behaving back to normal, which ones are generating positive returns, and we would re-leverage those first. And then if we see recovery across the board, we would put the systemic risk back to all the models. It's very difficult to, I would say, to fully systematize it, although we try to use as much data, as much tests and analysis as we possibly can.
Sure. Another question relating to drawdowns, and this goes probably more to you and your partner as human beings, and that is that the drawdowns certainly add to the emotional roller coaster that we all go through, and I wanted to ask you how do you balance that when you go through a drawdown, and maybe in particular, if you wouldn't mind, take us back to 2011 a bit, because what seems to me to have happened is that you go through your drawdown, which we all know is a difficult thing because you don't want to lose money for your clients, but at the same time you subsequently see huge outflows of assets, which I can only imagine really adds to that emotional roller coaster. How did you cope with that situation and stay on track? Because clearly your performance recovered, but just talk me through that, because I think there's so much to be learned from this.
Yeah, we fully recovered from that drawdown in July of 2013, and we ended last year at a new, even fresher new high water mark.
Yeah.
Again, very few CTAs can say that they have
absolutely
returns. Well, I would say that, on the personal level, the feelings that we had entering 2011 before the drawdown was, if we could survive 2008 market environment when VIX went to 90 at some point. So our models were trading in totally out of sample environment. We did not have prior data to backtest the models during the times when VIX is at 90. And they continued to perform extremely well. We had this sense of invincibility in a way. We thought, what other market conditions possibly could happen out there that will derail our program?
Sure.
If we were able to do well in 2008 and 9. And then, of course, the European debt crisis hit, which was impossible for us to predict or to prevent. And a totally new risk factor was introduced, which is credit defaults, swaps on certain countries that, we do not trade credit default swaps.
Sure.
By definition, they're illiquid, and we never had to in the prior years. So when we were going through our initial drawdown in 2011, first, couple of months, 2-3 months, we thought that, well, once in a while, we do have negative months. Obviously, we have some, bad streaks of returns, and we did not think that we could potentially have a drawdown that would last for 6 months. And then after 2-3 months, we realized that this is something totally different. We have to address the situation. And it took us some time to come up with some, modifications and ideas that we introduced in early September of 2011. So it took us, probably 2 months. I wish we could come up with them earlier, but we just, it
takes time.
It takes time, yeah.
Yeah.
Plus, I wish we had these deleveraging rules then that would prevent us from, experience such a deep drawdown. But again, I think I mentioned this point before. The experience of 2011 made us stronger as a firm, I believe. And even though we have less assets under management, as a firm, we are a better manager.
Yeah.
I would, if there's some, new managers coming out with 2 or 3 year track records that look outstanding, I would be very cautious because, every manager that has a 10-year track record had difficult time at some point. And the question is, how do they react to a drawdown? How do they react to a situation like this? And are they strong enough to withstand? Are they smart enough to improve?
Yeah,
and
sure.
In our case, we had, before 2011, we did have one drawdown of about 10% in late 2007, early 2008. So that was our second drawdown. And we recovered from both in a very, strong way. And my point is that going forward, like for example, in 2014, right now, we are having a drawdown. And I believe that, if you believe in the manager, if you believe in their ability to stay in the game, the best time to invest actually is not at the new high water mark. The best
Sure.
time to invest is during a drawdown. If that manager has a long enough track record and has shown an ability to improve and to recover. So, we are at this point right now, we are speaking with our clients and we are trying to explain to them that this is maybe a good time to allocate.
Sure.
You don't need to wait until we have another new high water mark, maybe sometime in the future.
Sure. No, I agree, Peter. Just one final question on drawdowns before we move on. Were there any time during 2011 when you were experiencing this drawdown due to circumstances that you, in a sense, had not foreseen and could not foresee, that you doubted the system and said, if we're going to be dealing with these kind of situations, countries going default, etc., maybe this is not the right way of approaching it, or how did you convince yourself that actually it was?
Well, we had a choice in 2011 to shut down because we made good money, and we had a choice whether to continue or to shut down. And the adjustments and improvements that we introduced in September 2011, even though we continued to see outflows, we really believed at that time that these changes will produce good things for us in the future. And we strongly believed in our ability to recover, and that is exactly what happened. But when you go through a drawdown, especially if it's a lengthy one, of course, you feel doubts and you feel like, oh my God, this strategy doesn't work. And that's how investors think also. They think this strategy worked before and it doesn't work now and it will never work again in the future.
Sure.
What we can see on our end is that it doesn't work now, but we do not agree with the decision it will never work in the future. So yes, if we're losing money, that is correct. The strategy is not working now. Absolutely right. But the difference is investors often believe that it will never work again. While we strongly believe, because we have inside knowledge, we have inside, skills and maybe better understanding of what we do.
Sure.
That this strategy will perform again, and it will become, again at some point one of the best strategies that we can invest in.
Yeah.
And so with this idea in mind, we continued, we improved, we fought, we worked extremely hard. We work around the clock, 24 hours. Again, it's a lot easier to take a trade and 2 months later to realize a loss or a gain. In our case, we, every day we work extremely hard.
Yeah.
And at the moment, for example, we are having a drawdown. The strategy at the moment over the last, few months was not working, but it doesn't mean it will not work again. we strongly believe that it will work again. And if we have investors that are convinced on that, they would be a long-term investors, and they will benefit at the end of the day, because if you buy at the top and sell at the low, by definition, you will lose money.
Sure. Definitely. And obviously part of your insight, part of the reason why you have this strong belief in the strategy is down to research. And research is actually the next thing I wanted to touch upon. Now, research is an interesting thing because investors, they want managers to continue to innovate, but they don't want managers to change. So how do you balance these two things, and how does research really work inside your firm?
We're doing some things that very few managers, I believe, are doing. We are estimating our parameters, not necessarily on in-sample data, but we try to use walk forward out of sample tests and scenarios to test how robust our parameters are. Because the biggest criticism of quants is that they tend to over-optimize their parameters that look quite excellent on paper, and then they start trading it and the returns are very different. So in order to avoid that, we are using different tools that we developed in-house here to make sure that our parameters that we choose are not just some overfit results. They are based on a lot more fundamental reasons why this should continue working. So this is the main area for us, to make sure that the models are robust, make sure that mean reverting statistical tests that we do are still looking good. And we look at each country individually. We look at how these mean reverting tests change over time. For example, for the full, let's say, 10-year history, or for the last 3 years, or for the last 6 months. And what we ideally want to see, we want to see no deterioration in the mean reversion tests, because for us, mean reversion is the key of the game. And that's what we're seeing. If we're seeing some signs that things are changing, that's when we would potentially deleverage our allocation to a particular country. That's why these once in 2-3 months rebalancing our risk is so important, because once in a while we have to intervene and make certain adjustments.
Now, I'm certainly no expert in mean reversion as a strategy, so help me understand how quickly can these kind of relationships change, and how easy is it to, or difficult is it to realize that something has changed, which is a little bit more structural or fundamental, however you put it, than just, something that's just gone, a little bit differently for a short period of time?
Well, when we estimate hedge ratios, again, I think I mentioned it before, we have a certain look-back window.
Yeah.
And if the hedge ratios, and by the way, we are recalculating hedge ratios daily.
Okay.
If the hedge ratios are changing rapidly in a certain direction, that means that markets are no longer correlating, or there's a breakdown in the relationship between the two. So on one hand, by estimating hedge ratios daily and adjusting them, we are making sure that we're trading the most recent relationships between the markets on one hand. But on the other hand, it could be an indication for us to maybe move away from that market altogether. I'll give you an example. A long time we traded Nikkei, Japanese yen, S&P relationship.
Mm-hmm.
And it was one of our best relationships, in the first 10 years of our existence.
Yeah.
Over the last almost 2 years now, we noticed that correlation of Nikkei to the rest of the world really disappeared after the new economic policies that were introduced in Japan.
Right.
So instead of waiting to lose money before we cut the risk, we actually did it before that happened. We noticed that correlations are weakening, the spreads are no longer stable, or the other way to explain it, hedging Nikkei with S&P no longer works.
Right.
We stopped trading that relationship, although overall it produced, before that, very strong returns for us.
And
so on one hand, we try to be dynamic in how we hedge as we trade based on most recent relationships. On the other hand, if these changes are too strong, we will ultimately cut the risk and stop trading.
Sure. And just one question to that example that you just mentioned. Now, clearly you would have noticed in the data that the relationship between the Nikkei and the S&P was changing. But in order for you to stop trading that relationship, do you have to go and look for the fundamental reason why it stopped working? And in this case, looking at Abenomics as the cause?
Often we would look at the data first, and then we try to explain to ourselves looking at the fundamental analysis. It's rarely the other way around. Because if there's some fundamental analysis that tells you, one thing, but data is continuing telling you something totally else, we would believe the data. We would not believe the fundamental analysis.
Sure.
So for us, data is number one. And then, of course, we try to explain to ourselves, what's the meaning of the data. But we trust the data first.
Yeah. Now, just looking a little bit on the business side of things, clearly you and your partner is crucial to this. But do you consider yourself as a firm to have a sort of a key man risk, or is it all so automated that actually, to a large degree, the company could continue without one or both of you?
I would say, for 6 months or so, you wouldn't notice a change.
Sure.
Either one of us disappears. But ultimately, clients have liquidity.
Sure.
Our clients have weekly liquidity. Managed accounts have daily liquidity. So they can very easily take their money away from us. But everything is automated. We have certain systems in check, how to do the research, how to do even marketing, etc. So longer term, of course, you will feel an impact, but not in the first 3 to 6 months.
Sure. Now, what's interesting, and I wouldn't say it's becoming the norm, but certainly a lot of managers have chosen to set up their business, a little bit outside the financial hubs. But you're right there. You're located in the middle of New York. Do you think being right in the center of the financial world helps you in any way, or does it not really matter where you would be going to the office every day?
I think it helps. It's easier for clients to come see us when they are in New York. We do have a lot of meetings in the office. Plus the overall energy of the city, the competitive spirit of you work harder every day. So, our lease, for example, expires in May of next year. And we plan to stay in New York, although it would be cheaper to go to New Jersey, for example.
Sure.
Where we do have actually secondary office, as a backup facility. But I believe staying in New York is very important. Yeah.
I think I may know the answer to the next question, but I want to ask it anyway, because I think, again, it is important for people to better understand. And that's really the challenges that you face as a business owner and as a manager. And what would you say the biggest challenge has been in the last 10, 14 years for you, and how did you overcome that?
Well, the biggest challenge is, I would say, to first convince clients that what we're doing is very, very beneficial to their portfolios. And it's quite upsetting to see them leave sometimes after, a drawdown, because if they believe in the story, they believe in the long track record, and if they believe in our uncorrelated properties, they should expect us to have sometimes negative months when their other managers are doing fine. So what we've noticed is that they like the uncorrelated property of your program when you make them money and everyone else is losing money.
Sure.
But when everyone else is making money and you're flat to negative, all of a sudden they don't like it anymore.
Yeah.
Which is, I guess, it's a human nature. But we highly, highly appreciate those investors that are for the long haul, and we hope that in the future we will get more of those managers, especially given the fact that we have 10 years of audited track record in the fund. I think smart institutional investors will recognize it and will have a better understanding of our returns going forward.
Yeah, and I think on that note, which is quite interesting, and I think we, as an industry, maybe we haven't been good enough at explaining to investors, why they should invest with us, because it's been the same argument that's been used, and clearly they're not strong enough, because we know that money has been flowing out, and I think actually today in our conversation, what you've done so far, is quite important, because in my experience at least, a lot of managers are very good at explaining how they make money and what they do, but they never really explain why they do it. And I think that's actually one of the challenges for the CTA industry, is to become better at explaining the why. Because I think if people understand why you do things and agree with them, they're more likely to, as you say, stay through the good times and the bad times, because they have something that they truly understand as to, why people do what they do. But anyway, that's just my own observation. I wanted to ask you a slightly different question, and that is, this industry started as a very US dominated industry. And certainly most of the famous managers, 10, 15 years ago were predominantly based in the US. But it seems to me that the last 10 years, European managers have actually, created much bigger firms than many of the US legends have. Do you have any observation as to why the European managers have become more favored, or have been able to grow their businesses much better than you in the US-based managers?
Well, maybe it's related to the investors and investors' appetite. Because when we were starting the fund, up until 2007 or 8, most of our clients were European investors.
Okay.
We gathered U.S. Assets, after we had 5 years in the fund, roughly. In track record. So I think European investors are more open-minded. They're willing to look at different things, and maybe that's related to that. That's just from our experience. Other than that, I don't know. Maybe Europe have smarter brains than US people, but it's a joke, of course. Sure.
Now, I've got a couple of more questions in this section, and then I wanted just to go on to the final area of my questions. But I wanted to ask you firstly. You know the CTA industry well. I accept you do things in a different space compared to many other CTAs. But if you were going to ask a question of my next guest here at Top Traders Unplugged about their strategy or their firm, what would you ask them?
Well, I would ask the trend following CTAs, why do they think trends will develop and the strategies will start working again after 5 years of fairly bad returns? That would be my first question. The second question would be related to where do these returns were coming from 5 years before, if we go back to before 2008. Because, as you know, CTAs do not use most of their cash for trading. The margin to equity on average, let's call it 15%.
Sure.
Which means that 85% on average is sitting in cash or allocated to some, instruments that produce some yield. And before 2008, we all know that if you were to buy a T-bill, let's say 90-day T-bill, it would pay you 3, 4, and at some point even 5% return annualized.
Sure.
Over the last 5 years, returns on cash holdings are zero. So my biggest question is to CTAs in general, what percentage of their gains before 2008 came from cash returns? And in my estimation, it could be well over 50%, which is a problem because if the low interest yield environment stays, means that for the next 5 years, CTAs might not produce this extra cash return that they were generating on the T-bills, let's say.
Sure. True. Now, I also wanted to ask you another question, which I think is really, really important. And that is, you've been in hundreds of due diligence meetings and you've probably had as many conference calls and so on and so forth with investors and potential investors answering thousands of questions. But
yes,
I want to ask you, what is the question in your mind that investors should ask you, but they never do? And this is in a sense to help them better understand your strategy. Is there something they're missing? Because part of why we're having this conversation today is to trying to ask different questions than the typical questions you get.
I believe investors are too focused and too concerned about so-called headline risk. If they invest with blue chips, they know that if they lose money with blue chips, no one will say a word because, a big firm lost their money. Things happen. If they lose money with a smaller manager, it could be a problem because people around them might say, well, why did you allocate to this manager? And why did you lose money with that manager? So I think investors should first be concerned about how liquid their investment is. Are they controlling the money? Let's say it's a managed account. They clearly control the money. If they invest via the platform, let's say Deutsche Bank, they clearly are safe. Even if they invest via the offshore fund or domestic fund, if the third parties involved in this fund are very reputable institutions like KPMG, the auditor, or SS&C, the administrator, and the custodians are Bank of America and Wells Fargo and New Edge, clearly they have very limited risk in terms of some kind of a fraud or ability to get their money back. So they should not be, I believe, it's my opinion,
Sure.
As concerned about the so-called reputational risk. They should be more concerned about how to build their portfolios. And partially the reason the fund of funds business model failed, because unfortunately the managers that were running the fund of funds, they were not building the right portfolios. They were either too much concentrated in similar names that have, let's say, 60-70% correlation to one another, or for other reasons. If they were doing a good job, if they were really building, portfolios that would withstand, difficult periods for different managers, I think the whole concept, is a good concept. It's just, it was not applied properly. So I would say, if investors are convinced that their money is safe, they should be more concentrated and concerned about a particular strategy and how it performs and how it adds to to their portfolio, rather than looking at some potential headline risk that might never be realized. And at the end of the day, they could be suffering in terms of the real returns for their investors. That's a pity, I believe.
Sure. No, absolutely. Now, the final section that I have is something I call general and fun, so a little bit sort of outside the norm and not specifically related to a model or trading program. But I just want to ask you a couple of things that might be useful for people to understand. And one of the things I wanted to ask you is just for the benefit of people who are listening to this and hoping to become the next systematic alpha, and that is, what does it take to become a great trader or a great CTA in your opinion?
I think you have to have an edge of some sort. In our case, we are occupying a certain niche of certain trading model that we believe is sustainable, but I'm sure there could be other interesting niche ideas that are not exploited at the moment. So for new people that are entering this area, if you have the right idea and if you believe that you're better at that idea than others, and if you work extremely hard, ultimately you will become successful. The road is not easy by any means, but if you are different from others, that's the only way, I believe, to succeed.
Sure. And since, as I said in the very beginning, this is also about getting to know you as a person to the people listening. So I wanted to ask you a little bit of a sort of a different question, and that is, do you have any sort of personal habits that you think have helped you become successful in this business over the years?
Well, just trying to keep my head clear. As I said before, Alexei and I have very different skills. I do not have quantitative skills at all, even though I talked about our research and
Sure.
how to do things, but I'm scratching the surface. Alexei is the real quant.
Yeah.
My biggest strength is, I mentioned it, it's so-called common sense, trying to understand what is good, what is not good, what makes sense, what doesn't make sense. And sometimes I am involved in our research process by simply directing our research where to look at or what kind of ideas to possibly exploit. I personally cannot backtest them myself.
Sure.
I don't have the skills, but I have this ability to see things and to challenge certain things that we do and to pinpoint some other areas that we could be, underlooking or we should improve. And this is my contribution to the research, I would say.
Sure. And as a business person, if we look at it that way, but also as an entrepreneur, which is obviously part of the journey you've been through, what do you think has been your biggest failure? I know we talk a lot about successes and people celebrate that, but often failures are the ones where we learn the most. And if you look back on your path, what would you say was the biggest failure, and what would you have done differently today?
Well, the biggest failure no question, happened in 2011 when we were unable to hold the assets that we had. We should have probably intervened earlier. We should have reduced risk earlier. We should have been more proactive with our clients, explaining what is happening. So before 2011, we had very few mistakes, I would say. And that's why we were able to grow our assets to a very sizable amount. And in 2011, as you mentioned before, it was a combination of bad performance, totally new environment, and assets leaving that unfortunately we did not handle the way we should have in retrospect. At the same time, all the changes and improvements that we implemented made us stronger. Our team is intact. Most our members have stayed with us for 6, 7, 8 years. So I'm happy about that.
Yeah.
And overall, and again, I will repeat myself, I strongly believe that we are a better firm, a better manager. We would do better things today compared to 2011 when we were a lot bigger. But it comes with, I guess, experience, and I think we have a lot of it.
Absolutely. And in order to end on a high note, I want to my last question to you, where I've had some interesting answers, let's put it that way, from other guests. I wanted to ask if you could tell me a funny fact or a fun fact about yourself that most people don't know about you. And I can reveal that some people have told me that they've been in movies or they do impersonations of so it's been very varied. But if there's something out there where you say, actually, this is something that most people wouldn't know about me, is there anything you can share?
About 10 years ago, I was writing lyrics, which I believe are very, very good, although I started writing them in 94 and I stopped writing them in 95. What the 20 years ago.
Wow.
And when I read some of these lyrics to some of my friends, they are shocked how good they were, and they're asking me, why don't I do it again?
Yeah.
And it's hard to say. I had inspiration and it disappeared. 20 years ago. I'm a business person now. I was a young boy then. Play guitar. I like to sing. Lots of things I can tell you about my person, but maybe some other time.
That would be that's for our next podcast. Peter, I wanted to before we finish, I wanted to ask if you could tell the listeners what's the best place to reach out to you and learn more about your firm and, of course, the new offering that you're coming out with in terms of a UCITS fund.
Well, we do have a website, systematicalpha.com. We also have our marketing director, Sandy Chotai, who can be reached at 646-825-8075. He is very good in explaining what we do, how we do things. We are coming out with the UCITS project, with UCITS fund. Very few CTAs have UCITS because their programs do not apply under the UCITS rules, because a lot of them trade commodities. And in our case, most of the trading that we do is in global equity indices and currency futures. And basically, we will be doing the UCITS project for two reasons. A, demand from European investors, and B, from the regulatory standpoint, it's becoming more and more difficult for US-based managers to come to Europe and to market themselves. Once we have UCITS, it's not a problem at all. So this is why we're doing it. But yeah, we have our website. We have a very good in-house marketing director that can answer any questions. So please reach out and we will respond.
Sure. Fantastic, Peter. Thanks ever so much for your time today, and also thanks for I think a great conversation. I really appreciate that you've been very open and willing to share your insights and your views on the evolution of your firm and your strategy as well as the industry as a whole. I think that is so important. So I appreciate that, and I hope that our listeners will find a way to thank you as well, whether it's social media or by contacting you directly. And of course, the listeners can find a lot of details about our discussion today in the show notes on the website toptradersunplugged.com. And I hope we can connect at a later date and see where you are and all the great work that you do.
Sounds excellent. Thank you.
Thank you so much. Take care, Peter.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.